Welcome to Nicola Wealth Outlook 2025. My name is Chris Nicola, and I am the president of Nicola Wealth. We are pleased to provide this in-depth presentation on the markets, financial planning, our asset management, and as always, our team's outlook for 2025 and beyond. We are recording this just weeks away from Canada's next federal election. From where we stand, the outcome of the Canadian election looks almost certain. The geopolitical state of the world is anything but. The theme for this year's outlook is defense by design. We are facing a world of increasing polarization, deglobalization, tariffs not seen since the 1930s, and winds of political change blowing throughout. These risks are real, and we've been witnessing their impact on the markets in real time. But as always, this will pass, and in doing so, create opportunities. In the next 90 minutes, our CEO and CIO, John Nicola, along with our team, will share their outlook for 2025 and beyond and help you understand how these events will affect your investments, your business, and your family. They will also share what Nicola Wealth has done and continues to do to position your investments defensively, to create stability amidst the chaos through our focus on value, reliable cash flow, and expert financial planning. To start us off, John Nicola will take us through his view from 10,000 feet of the current state of the world and the markets, and show us where we can expect to be heading over the next few years. Next, Executive Vice Chair and President of Institutional, David Sung, will introduce our asset managers to walk you through how they are seeing the public, private, and real estate markets in 2025, and how they've defensively positioned our portfolios to handle increased volatility. Finally, Vanessa Flockton, our President of Private Wealth, will walk us through a client's case study on how to play effective defense during times of uncertainty. Our goal is that you leave these presentations with a clear sense of confidence, not only in our deep understanding of the markets, but also in our disciplined, strategic approach to wealth preservation and risk management. Thank you, and welcome to Outlook 2025.
Good day, everyone, and thank you, Christopher, for that very warm introduction. Most of us have heard of this phrase, may you always live in interesting times. It's supposedly a Chinese curse. As it turns out, it's often mistakenly to be that ancient Chinese curse, but it's actually an English expression that evolved from a British diplomat's observation about Chinese culture. The irony of the phrase lies in the fact interesting times are often times of hardship and turmoil, not necessarily good times. And that is where we find ourselves today. Another metaphor to consider that we're very familiar with is sometimes an individual can't see the forest for the trees. But in this image, of course, we can, because we're 5,000 or 10,000 feet above the forest. We can not only see the trees and the overall forest, we can see this river snaking through it. But if we were on the ground, and we were 50 or 100 meters from the edge of that river, we wouldn't be able to see it because we couldn't see through the trees. So what are the other things related to the things that we can find from 5,000 or 10,000 feet? Well, starting with rising interest rates and inflation and the impact on your money, specifically on your portfolio. The impact of Trump and the Liberation Day tariffs and the ones that came before it as well. Where are we in the electoral cycle? It's a short time before we find out who the next prime minister of the country is going to be. And as of the middle of April, a U.S. stock market not necessarily crashed, but major correction that has impacted a lot of portfolios all over the world. Finally, what's the impact of geopolitics on all of this? Well, let's examine that as well. There is a huge set of issues between China and the U.S. Some of them are military, some of them are cultural, and most of them are economics, and we'll discuss that as we look more into the trade war between these two countries. The impact of the Ukraine war and the fact that there's apparently no end game, no truce that's going to occur at least at any time soon. The question about how we, certainly we as Canadians, handled the issues of trying to find out what is predictable about Trump and his own behavior. Finally, obviously populism has arisen significantly in the U.S. over the last number of years, but that's not the only place where it has risen. maybe we should examine a little bit about why that might be the case. This is a really good definition, at least one I like, of economics. It is a science of explaining tomorrow why the predictions you made yesterday won't come true today. Now let's talk about another individual who's not an economist. He's a geopolitical strategist named Ian Bremmer. And he is brilliant. He speaks often. He's written a number of books. And he came up with his list of the top 10 risks of 2025. Let's take a look at some of the key takeaways from that article. The first is that he believes that Mexico will suffer more than, let's say, Canada as a result of U.S. tariffs, specifically because Trump doesn't like the President Sheinbaum of Mexico as much as he did the previous President AMLO. AI is in an unregulated environment, so its outcomes are more and more unpredictable. Countries are very focused on their own specific needs as opposed to the global world order. Trump himself loves oligarchies and basically would prefer to be the equivalent of Putin and Xi as opposed to a democratically elected president. There is no G7 or G20. There's just G0 with everybody looking after their own interests. Trump truly believes tariffs will work. They won't, and he's not prepared for the economic fallout of higher prices and unemployment at the same time. And from another political observer, Trump is the individual who is the head of state as the president, but Musk is effectively the head of government. Now, let's take a look at this impact. You can look up populism on Google and you can find a variety of images related to the trend in increasing populism all over the world. And there are a lot of reasons for this. Some of them are stated by, at least from the American perspective, would tend to look like this. A question is asked, who and what is to blame for your problems? By the way, that happens to be a quote of a question from an old movie called The American President with Michael Douglas in it. It's just ironic that it seems to apply also to Trump. And the answer is, it's either the immigrants crossing the border illegally, it is drugs crossing the border illegally, or it is trade goods crossing the border legally, but eliminating U.S. jobs. And that's what's to blame for your problems. But maybe there's another way of looking at this. And the other way is to say, what's happened to, quote, the average American over the last 60 years? What you're looking at is a graph of average household income. This was done at the end of 2023. And what it shows is that the top 5% of the population has seen a 160% increase after inflation in their income over 60 years. The bottom 40% have seen no change in their income in the same period of time. There's been a complete transfer of wealth in both income and assets in the U.S. and in a few other countries, but primarily in the U.S. over the last 60 years. You can see this in a comparison of English-speaking countries. You notice in the far right in the red that we're looking at the income percentage controlled by the top 1%. And in the U.S., you can see easily that it's 21%. But in New Zealand, Canada, and Australia, between the three countries, it's about half that, around an average of 11%. So this distortion of wealth is the main reason that people that were part of MAGA are really feeling that they're making no progress in life. It's got very little to do with the other factors we potentially looked at. One of the other things about the U.S. is the U.S. historically has always had tariffs, and some of them at extraordinarily high levels, especially when the country was just getting started. But essentially, since World War II, since the U.S. had its greatest real growth rate in its history, basically it's had the lowest tariffs at the same time. And before World War II, tariffs were supported primarily by Democrats as opposed to Republicans who support them now. And of course, recently these tariffs got to ridiculous levels with this on-again, off-again, tit-for-tat negotiations, or not really negotiations, but really a war between the U.S. and China, starting at basically tariffs that were at 10% or less, and then escalating first to 20, then to 25, to 30, then to 34, then to 84, then to finally, 2 or 3 days ago, 145% tariffs by the Americans on Chinese imports 125% responsive retaliatory tariffs by the Chinese on U.S. imports. And then, because Trump is so mercurial, he changed his mind literally within 24 hours of this 145% announcement and said, oh, we're going to exempt electronics and computers and smartphones from China tariffs. And that seemed to be a reprieve. And that reprieve lasted maybe 36 hours. And we're going to find out very soon what the new tariffs are going to be on computers and electronics and smartphones. The bottom line is they're not going to be zero, as was announced a couple of days ago. So these tariffs started with originally tariffs on basically Canada and Mexico, 25% on products, and especially steel and aluminum, and then a 10% flat tariff on China at that time. The argument Trump makes about tariffs is they're a guaranteed way of raising money, and maybe 200 years ago that could be said to be true, but with the size of the world's economy and the number of bilateral trade agreements, that revenue that Trump is expecting in the hundreds of billions of dollars will never materialize, because these goods will simply stop coming into the U.S., or U.S. consumers will look for alternatives to buy that are not subject to tariffs. So the revenue simply won't be created. The other fallacy, of course, here is that Trump still believes that the tariffs are effectively a tax on foreign countries, which is insane, because the tariffs are paid by American businesses and consumers. So essentially, they are the equivalent of a sales tax. And the other thing to look at is who's going to pay this tax in the U.S. If we take a look at the bottom 20% of the population, their incomes will be affected by about 5.7% with these tariffs in 2026. The richest 1% will be impacted 1.4%. So it's not even just a tax on Americans, it's a tax on poor Americans, and with the largest benefits going to the wealthy. So here's a couple of other facts about the U.S. that we should be aware of. So the U.S. GDP is expected to reach about $30 trillion in 2025. The budget deficit is around $1.9 trillion for this year, which is about 6.3% of GDP. By comparison, Canada's GDP is around 3.1 trillion Canadian dollars. Our deficit is about $60 billion. That means it's about 2% of GDP for 24-25. So 1/3 the level of the U.S. And our total government debt is $2.2 trillion. That includes provincial debt on a net basis, around 75% of GDP. In the U.S., the federal debt alone is 124% of GDP. And that's up from 40% 50 odd years ago. And China is actually not in a better position than the U.S. Their total debt, including corporate and personal debt, is over 300% of GDP, one of the highest in the world. Finally, on things like Elon Musk talking about Social Security being a Ponzi scheme, he has a little bit of a point in that there's about $3 trillion of assets in the Social Security fund coming from contributions that employers and employees have made. But they're all invested in U.S. bonds at a total return of around 4%. In the meantime, many years ago, decades ago, we made a decision with the Canada Pension Plan to increase the premiums to make it funded and to allow CPP to invest the money to get the best possible return. Because of that, it's now a $700 billion fund, even though we're 1/15 the size of the U.S. economy, and it's got an annualized 10-year return of 9.2%. There's no comparison. CPP and all the major defined benefit pension plans in Canada are fully funded, and that is simply not true with the U.S. Social Security. Other things that have happened recently, this is the U.S. dollar index, and it's dropped about 10%. There are some individuals talking about a conspiracy theory where the Trump administration wants to weaken the U.S. dollar. The problem with that, of course, is if the U.S. dollar weakens dramatically, then you would expect interest rates to rise, because what it means is that a large part of the debt, more than $8 trillion of U.S. debt, is held by foreign countries. If they felt the U.S. dollar was going to drop dramatically over an extended period of time, they would sell U.S. bonds, and that's exactly what they did do a couple of days ago. The Japanese, in particular, were the largest sellers at that time, and it caused interest rates to rise by almost 50 basis points in about 3 or 4 days, which is a very significant rise. This was the primary reason that Trump basically backed down on his tariffs and created the 90-day pause. This was the reason, not because the stock market was falling. This is a much bigger danger for the U.S. And when we take a look at the only country that is the exception to the dollar index debacle that's occurring, it is actually the Chinese renminbi, or it's easy for you to say, Chinese yuan. So it's decreased in value by 16% since 2022. One way for the Chinese to overcome tariffs is to try to devalue their currency, because then they can still get, if you will, the same amount of yuan for a certain amount of product. The problem is that there's no way, if the tariffs were 20%, that could work. If the tariffs are 145%, there's no amount of trade that's going to happen at any significant level between these two countries. Let me switch gears here to where we are in Canada. We have a new sheriff in town, at least for the time being. And we have to take a look at what's the difference between these two individuals. And I'm just basing it on the policy platforms that I've just recently heard. But what I hear is they're going to reduce taxes for the middle class. They're going to eliminate the carbon tax for consumers, which apparently has already occurred. No increase in capital gains rate, which has been agreed to. They're going to fight Trump on tariffs, align more with Europe, protect our sovereignty. So the question is, plus a change, plus même chose. In other words, what's the difference between the two platforms? And it's going to be interesting because Canadians will have to make that decision very soon. So there appears to be a balance that has shifted. Initially, it was in favor of the Conservatives, and then when Carney became Prime Minister, it was deemed that he might be the better person to negotiate with Trump. That is starting to level out a little bit, but right now the Liberals are ahead of the Conservatives in terms of this particular electoral race. One of the things that Trump accused Canada of, this is one of the things that got us very angry in the first place, was that there's a $200 billion trade deficit. He means $200 billion US dollar trade deficit between the US and Canada. The actual trade deficit, according to this chart I was able to get, is $93 billion Canadian, or $63 billion US, 1/3 of, again, of what Trump's exaggeration was. And of that amount, 131 million of that is in the form of mineral fuels, oils, distillation products. In other words, these are products that the U.S. cannot get anywhere else. So it's not as if they can just replace them on their own. And so really, for all intents and practical purposes, we don't have an effective trade deficit with the U.S. And then when we're talking about the Canada as the 51st state, I was just thinking, ironically, if we were the 51st state, we would, the Republicans, I should say, would have lost the Senate, they would have lost the House, they would lose the presidency, and they would lose it for a long period of time, simply because we would be just effectively another California in terms of voting. So these are my own thoughts about what good looks like 3 to 5 years out for Canada, and what I'd like to hear in terms of the balance of the election from the two major candidates. Number one, reduce the trade dependency in the U.S. to below 50%, particularly in materials and services that are difficult for them to replicate, like energy and potash. Expand CETA with Europe as much as possible and develop a trans-Pacific trade model to double our trade with that region. Eliminating 90% of interprovincial trade barriers. Refining immigration policy to attract the best global talent, including from the U.S. Properly funding our military commitments as we have in the past when necessary, and developing a robust industrial policy focused on R&D and productivity. Now, obviously, I'm not running for office, but I would be looking for these commitments from, the contenders for the next Prime Minister. Let me switch gears here to the world energy outlook and the impact that solar and wind are having on renewable energy. It's quite significant. At the same time that's occurring, the shale oil revolution continues, and production in the U.S. has exceeded consumption for actually a number of years. And the U.S. is the world's largest producer of oil, and actually exports oil significant volumes, but at the same time imports oil from Canada for completely different reasons. Canada exports 61.6% of the oil that the U.S. imports, and that's probably around 6 million barrels a day in total. They need the kind of oil they're importing from Canada, which is heavy oil, and it works in the refineries, especially in the northern part of the United States. And it can't be replicated with shale oil, which is too light. So they have to have the oil that they can get from Alberta, or their refineries won't work functionally. When it comes to solar power, this is a map, remember from a book that Peter Zion had put together about where is the greatest potential for solar power. And where you're in red or orange, to some degree yellow, is the greatest potential for solar power. Now, interestingly, if you look at the numbers, the US and China are both relatively, especially Eastern China, strong potential for solar power. So is North Africa, obviously so is Australia, other parts of South America, and southern parts of Africa as well. So the US could be an extremely large provider of renewable energy, both wind and solar. Now, when we take a look at the fact that it's 18% of the US power grid, and finally we're getting to a point in technology where battery storage is able to manage and hold on to a great amount of solar and wind power that's generated, but needs to be used at a later date. And this is what's actually happening. So what you're looking at in the blue here is the amount of energy that was created between 2017 and 2022 that's renewable. Again, China outpaces everybody else. In fact, I believe that China's total for the last 5 years is more than all other countries in the world combined. And its intention for the next 5 years, from when this was done, 2023 to 2028, is to do that again by a factor of 3. But that's true for every one of these countries. So we're going to see an impact on fossil fuels, and it will be significant as a result of this. Let me turn myself again to something different in terms of a topic. This is called the Global Wealth Pyramid. And this is done 2 or 3 years ago, but what it pointed out was that the global wealth, in other words, the value of all assets held by individual households, was roughly $463 trillion. So let's say today, safely over $500 trillion, okay? But the value of all stock markets in the world, where most people have their money invested, is only $109 trillion. And roughly speaking, it's about 1/5 of the total of the global wealth. And it calls into question what people's individual asset allocation should be. So let's look at global investable assets then from a pie chart perspective. You know, we have multifamily housing, residential, commercial, real estate, farm and timber, significant. Public equities, as I mentioned, just over 20%. Securitized debt, which really is fixed income, so bonds and mortgages and assets like that, and then a very small sliver for other assets. And this graph here does not take into account the value of private assets and private enterprises. So if I took all the private businesses in the world, which in theory, in some cases at least you can invest in, that probably would add as much as $100 trillion US to this pie. So the question is a simple one. That purple area is public equities. Why would this be 65 to 75% of anybody's investment portfolio with all the rest of the investment options existing? Well, for the Maple 8, so if you don't know who the Maple 8 is, the Maple 8 are the top 8 defined benefit pension plans in Canada. That includes AIMCO in Alberta, BCI in BC, Caisse de Depot in Quebec, CPP Investments, for example. These 8 plans together manage over $2 trillion of assets for Canadians, so it's a huge amount of capital. Okay, number one, on average, they're just under 25% in public equities, so they're basically investing it on a balanced basis as they see world assets available to them. And when it comes to their performance, they're considered to be amongst the top asset manager performers in the world, better than many, if not most, sovereign wealth funds and other kinds of institutions. So they're punching above their weights, let's say that much. All right, so let's take a look at how we stack up against them. First, let's take a look at 4 of them, these pension plans. And what we're looking for here in the yellow, highlighted in the yellow, is how much of their assets are in non-tradable, non-public assets. Well, between infrastructure, real estate, and credit, that's 45%. When we add private equity into it, that's another 20%. So they are 65% in non-public assets, which is far, far higher than the average investor would be in Canada or the US today. So when we built our original model for this, we wanted to go beyond stocks and bonds for these reasons, because we looked at best practices, and this is the best practice of some of the best institutions in the world. So the asset allocation structure is your strategic asset allocation. That's looking at the whole. Then you have to look at the parts. That's a tactical asset allocation. How is each part of that whole performing? So globally, since 2000, we've maintained a model in and around this mix for a significant period of time. And as a result of that, when we compare it to, say, traditional balanced funds, it has outperformed by a factor of, well, almost 2 to 1. So if we were investing $1 million back in 2000, we would have approximately $3 million today if we were in a balanced portfolio, and we would have $5.6 million in the core portfolio, which is the average of all of our clients' performance over the last 25 years. And where would that stack up? If we just looked at the last 10 years to December 31st, 2024, what we would see is that amongst the Maple Lake, keeping in mind that this is a group of pension funds that is outperforming global outcomes, we would actually now be in third place over the last 10 years. So we're very comfortable that this model is ideally suited to low risk and high return outcomes for clients. So let's take a look at the strategic asset allocation normalized model. Roughly, in our case, a third in equities. That includes public and private, not just public. We have 34%, about a third in fixed income, and a third in real estate. And we change these percentages by 2 or 3 points either way, depending on the markets, level of interest rates, the economy, and if we're in a recession, any number of things like that. So there's the current model, and it's changed. We have a much higher allocation to fixed income. You can see it's gone to 38%, reducing exposure both to real estate and equities. And that is the model that we're currently just coming out of, and likely based on what we're seeing today with interest rates, we're likely to stay in for a while. So let's take a look at what we do in each of these categories. In fixed income, 60% of our fixed income is public, in bonds and high yield bonds and the like, and 40% is private in terms of private debt and mortgages. But we have to look at other things. Should we invest in high yield versus government bonds? Should we invest in what kind of duration, short-term bonds or 10-year bonds? Should we use leverage at any point in time to enhance returns? Are mortgages better investments than corporate debt, for example? And what currency should we be investing in, US dollars and euro or Canadian dollars? And so those are the tactical decisions we make. Then when it comes to equities, we have a similar set of questions. Again, 70% of our equities are public and 30% are privates. And we look at other aspects, Canada versus the US versus international, large cap versus small cap, private equity versus venture capital, growth versus value. And then when we're talking about public markets specifically, we have a reason to be, we believe, a good reason to be quite nervous. What you're looking at here is the Cape-Shiller 10-year PE ratio. Cape-Shiller refers to using a PE ratio that tracks the average over the last 10 years. So it tends to be relatively elevated compared to current PE levels. But it represents long-term risk-adjusted value. Now what you can see here is in 1929, that was one of the peaks. 1936 was one of the troughs. 66 was another peak before there was a lot of stagflation during the late 60s and 70s. In 2000 was the highest it's ever been during the dot-com bubble. 2008, not the lowest, but one of the lowest numbers during the nadir of the great financial crisis. And where are we today? Essentially, we are at the second highest level that we have ever been, and higher than we were in 1929 in terms of valuations. So regardless of Trump, it seems to me that it would be reasonable to see a significant market correction over the next 2 or 3 years anyway. What Trump has done is accelerate that market correction through his tariff policies. And one thing you can take a look at is Warren Buffett, and he's still around, still doing some pretty great stuff. He's been raising money. He now has a hoard of cash of $325 billion, which he's been building up over the last 24 months. This is since before Trump got elected. And he has more cash now than Apple, Microsoft, Alphabet, and Amazon combined. The other issue that is a challenge for public markets is that the public markets themselves are actually shrinking. About 45 years ago, there were about 8,000 publicly traded companies in the US. Today, that's almost been cut in half, and is now down to around 4,000, the lowest it's been since roughly 1980. So basically, the ability to buy public companies has shrunk. More companies have made the decision they don't want to be public. It is cheaper for them, more effective for them to raise capital in the private markets. And when we take a look at returns in the private markets, you can see when you compare the S&P 500 to the North American Private Equity Index by PitchBook, you can see that it has outperformed, private equity has, over 20 years, 15 years, 10 years, and 5 years. So that's part of the reason why we believe private equity is a major place to play in a portfolio. And then let's talk about real estate just briefly. So real estate in our case is about 90% private. Only 10% of it is in publicly traded real estate assets. We still have a lot of questions to ask: Canada versus the US, industrial, office, retail, multifamily, residential, specialty, income versus development. Should we build our own assets, or should we just buy them as mature income producing assets? Are we buying existing? And where is that? What geography are we looking at? What demographics are we looking at? So part of the reason we like real estate as an asset class, this is a study that was done by The Economist, I want to say 10 years ago, at least in terms of when the numbers were collated, but they were collated over an incredibly long period of time, 145, 50 years, and in 16 different countries. They took a look at asset class returns in the following categories: T-bills, bonds, real estate, and equities. And equity markets were just beginning to be publicly traded back then. And of course, T-bills had the lowest rate of return, as to be expected, short-term duration bonds, with the lowest amount of risk at 3.3% volatility. Bonds had a higher return and higher volatility, as you would expect. Real estate, again, had a higher volatility, but a significantly higher return at 11.1%. And equities had a similar return to real estate, but double the volatility. So we look at real estate as being equal in the long term to building wealth the same way you can with publicly traded equities, but do so at a lower amount of risk. And the returns, most of the return, but not most, maybe half the returns come from cash flow or rents in this case, which is a much higher percentage of the total return than you would get from stocks, where maybe 25, 30% would come from dividends. One of the other things that we look at is, why don't we invest in real estate trusts? I mean, they're available in both the US public markets and in the Canadian public markets in the form of REITs. Now, what you're looking at here is a graph. It might be a little hard to read, but the blue line represents how our clients have performed in real estate over the last 20 years. And the red line represents the TSX REIT index in that same period of time. And what you can see is that the rate of return for our clients is 3.12% a year higher than they would have received if we had invested in REITs instead as a real estate proxy. The total cumulative return is 112% more over that 20 years. And the risk, the volatility of the portfolio, is 83% less, which leads to much, much better investor behavior. Which brings us again to our final area topic that we want to cover: behavioral finance. And this has been around a long time. I was looking at what the origins were, and apparently this is the book by Vasilios Kalintarakis, I think is the proper pronunciation, I'm not sure. A book written in 1688, and a more current book written about 20 years ago called The Little Book of Behavioral Investing is one I can easily recommend to anybody listening to this webcast. And essentially, in 300 years, you can say history does not repeat itself, but it often rhymes, and that from Mark Twain. So behavioral finance deals with a lot of things that have been documented to be true about the way we behave when certain things occur in investment marketplaces. So for example, and we've written about this as a newsletter that you can get, and we just recently updated it, called 7 Habits of Highly Ineffective Investors. But prospect theory is a perfect example, where you feel twice as much pain as you do joy when you are, if you lost $1 as opposed to earned $1. So therefore, you're more likely to hang on to your losers, and you just don't get the same reward from being $1 ahead on a particular investment strategy. Let's take a look at over-optimism. Well, that sort of speaks for itself. You know, the inclination is for things to just continually get better. Overconfidence, it's like the kids of Lake Wobegon. The 80% of the people in any particular group think they're in the top 50% of everything. And obviously that can't practically be true. Anchoring is tying yourself basically to something. If you've already bought something, an investment, you're automatically going to rationalize and justify why you have it. As opposed to, of course, if you didn't own it now, you might be quite critical about the idea of investing in it. Cognitive bias and cognitive dissonance is where you have a disconnect between reality and your perception of things. And playing with house money is the equivalent of going into a casino and earning $1,000 as very quickly, and then deciding that you can stay in the casino and you can afford to keep gambling because you're playing with house money. No point does it occur to you that you're actually playing with your own money because you actually had already won it. And then finally, ambiguity inversion. You don't like listening to information where you don't really understand it, and therefore it's not as clear to you as you would like it to be. Therefore, it's easy to ignore it, and you would just basically hold on to the position you're currently in. You don't want to crystallize any losses. And I'm sure there's a lot of investors in today's market, after being down 10, 15, or 20% in any particular security or fund, that are in that position today. So, what are the things we need to think about? Number one, portfolio rebalancing is a critical aspect of what we do for clients, and it can make a difference all by itself of 90 basis points per year in the performance of just simply buying, hold, and not changing the portfolio allocation, not rebalancing. The overall asset allocation between stocks, bonds, real estate, and cash is a critical issue. That's the strategic part of what we want to do with clients' capital. We want to avoid volatility, and that's one of the benefits of private assets. It reduces volatility, and which also improves investor behavior. And finally, overall behavioral finance. These are the issues that you have to look at: cognitive dissonance, overconfidence, anchoring, all of the things we talked about just a couple of minutes ago. So these things together will make a significant difference in the performance of any portfolio. Now, there's some proof in this pudding, so we thought we'd show this particular slide. In the last 25 years, there have been 4 major periods of crisis in terms of, let's say, equity markets. So starting with the dot-com bubble of 2000 and 2002, our clients earned a return of 8.7% positive, while the stock market from top to bottom dropped 34%, the S&P 500. In the great financial crisis, our clients did lose money. They lost 6.5% of our portfolios when the markets were down 42%. Now, during COVID, our clients were down minus 2.2% when the markets dropped 19%, and then finally did recover relatively quickly. And then in 2022, markets dropped another 18%, and our clients were up 6.6% in that period of time. So when I measure all 4 of those areas together, the simple average of them all, during times of crisis, our clients are either break even or slightly up at 1.5% against the market average of being down 22%. And I can almost assure you that these numbers are what account for the fact that our balanced portfolio has outperformed traditional balanced portfolios by about 2.5% a year since 2000. Most of that excess return we're talking about occurred during these 4 periods of time. So this is, we'd like to think, is the end of using 60-40 as a way to fund your retirement portfolio. So just, as a summary, just remember what crisis investing looks like and what the results are in terms of client portfolios. Better performance in a crisis equals superior long-term results. You have to, in a way, imagine this different metaphor. This is of a duck paddling, looking very smooth and silky on top of the water. But if you look under the water, they're paddling like crazy to actually get the results that they want. So with that, let me hand it over, and thank you for being here.
I'm David Sung, Executive Vice Chair of the Board at Nicola Wealth and President of Institutional. Markets around the world have been rocked by renewed volatility, spurred by escalating trade tensions, shifting global alliances, and growing political uncertainty, both at home and abroad. Questions around economic stability, sovereignty, and leadership are creating an environment where unpredictability feels like the only constant. We believe it's more important than ever to remain grounded in a disciplined, diversified approach to investing. In this segment, we'll hear from our asset managers. They will show you how Nicola Wealth and Nicola Institutional are positioning across asset classes to not just manage risk, but uncover opportunity. You'll hear how we're navigating overvalued public markets with patience and discipline, how we're leaning into dividend strength and global diversification, how we're actively managing real estate and private capital in a rising rate, capital-constrained world. Lastly, you'll hear how we're maintaining our edge by blending institutional strategies with a nimble, client-first approach. At Nicola Wealth and Nicola Institutional, we're committed to what we call an all-weather investment strategy, one that is rooted in true diversified portfolio strategies, and how is structured to both reduce volatility, like what the public markets have experienced this year, as well as how it can perform through the full market cycle. Now, this is not a new philosophy for us. We've been building diversified portfolios for over 25 years, not just with public stocks and bonds, but with meaningful investment allocations to hard asset, real estate, and institutional quality private capital. This three-pillar structure of public assets, real estate, and private capital provides our clients with access to asset classes typically reserved for very large pensions and sovereign wealth funds. We structured our first hard asset real estate opportunity more than 25 years ago, which has now evolved to a $10 billion real estate platform. Today, our clients participate in portfolios of income-producing commercial properties across North America with strategies that span core income-producing real estate, value-add, and real estate development. We've also built a robust platform of private capital solutions, offering access to private equity, private debt, institutional-grade mortgages, infrastructure, and venture capital. This is a fundamentally different experience than what most investors have traditionally had access to in Canada. While the broader wealth management and investment industry is now only beginning to explore alternatives, Nicola Wealth and Nicola Institutional have been pioneers, creating open-end, evergreen, private asset class investment funds designed specifically for high net worth individuals, families, charitable foundations, endowments, and family offices. Our clients benefit from a truly integrated portfolio strategy that blends public and private assets together to create more consistent, resilient outcomes. Effective investment management requires an informed and methodical approach, and that's exactly what we aim to deliver through research, risk management, and the deep expertise of leaders who run each pillar of our platform. In this presentation, you'll hear from each of them. Ben Jiang, who leads our public asset team, will share how we're positioning public equities and fixed income in this environment. Mark Hanna, head of Nicola Real Estate, will provide updates on our Canadian and US real estate funds and how his team is finding opportunities in an evolving real estate cycle. And lastly, Rob Olson, who oversees our private capital platform, will walk through performance across our private asset strategies and how we're navigating forward. These asset management leaders and their three teams form the foundation of our asset management platform. And they're a big reason why Nicola Wealth and Nicola Institutional continue to earn the trust of clients across the country. Whether you're seeking stability, growth, or both, this is where a truly diversified strategy earns its place. Thank you again for watching. I hope you find these updates helpful and insightful, and as always, we appreciate the opportunity to be stewards of your wealth and your capital.
There's a lot of uncertainty out there, tariff uncertainty, geopolitical uncertainty, and there's risk with that uncertainty. But for public markets, how do we define that risk and how do we mitigate it? For almost all of my family vacations, the highlight for the kids is a hotel pool. And every time we get to a new pool, I make sure to take a look around. I look where the deep end is, and I look how deep the pool gets. That's risk. When people talk about public markets, they talk about the S&P TSX Composite or the S&P 500. These are indices. They're aggregations of hundreds of companies. And when people talk about expensive multiples of being 21 times, they're talking about the average of all of these companies. Now, the true risk at the swimming pool doesn't lie with its average depth, and the risk with markets doesn't lie with its average multiple. Risk is about extremes, extreme environments, extreme multiples. Heading into this year, US markets were trading at extreme levels, roughly in the 99th percentile relative to history, but it took time to get there. It didn't just happen overnight. For the last several years, the US market has been on tear, even when markets were expensive. Stocks got more and more expensive. In reality, that's not abnormal. When looking at stocks, we look at numerous factors, including earnings growth, dividends, along with valuations. The relationship between valuations and future stock returns, it's linear, but it takes time to materialize. It's not a short-term or even an intermediate-term relationship, but that relationship over the long-term horizon holds. Expensive stocks have a lower return, while cheaper stocks have a higher return. It requires patience to not chase the latest hot trend when valuations get stretched. It can be difficult, but it's an important part of having a disciplined investment process. Now, markets have been volatile, both on the downside and the upside. But that volatility will likely persist. President Trump is in power over the next 4 years. And potentially even more important, there are almost 2 years left until the midterm elections. Even if we have more clarity on tariffs, Pandora's box has been opened, and you can't put things back in the box. The US, they've been a great friend and trading partner for many countries globally. But now those countries are hurt by his actions. Even with the trading resolution, it's likely that scarring has occurred with these relationships. People are unlikely to just forgive and forget. As we speak, countries are working to find alternatives. They're looking to connect with each other and reduce their dependence on the United States. So how are we dealing with this environment in your portfolios? Well, for equities, we're focusing on dividend payers and growers, particularly in Canada. Dividend payers and growers have significantly outperformed the overall market during periods of market volatility, while keeping in line when there are periods of strong returns. Even more important, in times like these, when we look at dividend payers and growers, the long-term returns, the attractive returns, they're not only strong, but they've been achieved with lower volatility than the rest of the market. We're focused on diversification, global diversification. Europe, it's not immune to the actions in the United States, but the European stock market started the year with much more attractive valuations. Countries like the UK, they're a much more service-oriented economy. It's much less reliant on the production of goods, and thus less sensitive to tariffs. The US revenue exposure for European companies, it's only 26%. But when we take a look at revenue from goods exported to the US, it's only 6.6%. In addition, countries like Germany have now adopted more pro-growth policies. They've lowered corporate tax, lowered value-add tax, lowered personal income tax. They've paved the way for a €1 trillion defense and infrastructure splurge. All of these things set the stage for attractive returns from a reasonably priced starting point. Now, the VIX, a measure of volatility for equity markets, skyrocketed after April 2nd, the announcement date of sweeping tariff hikes, or as President Trump refers to it as, Liberation Day. The VIX spiked to levels we haven't seen since the depths of COVID. Similarly, the MOVE Index, a measure of volatility for the bond market, spiked as well. There is fear in the bond markets, and appropriately so. The US is still grappling with latent inflation, and tariffs are inflationary. The economy could very well face headwinds, but these inflationary pressures, they handicap the Federal Reserve's ability to cut interest rates in a meaningful way. So it's very possible that interest rates will be less of a portfolio diversifier in the future. They might not play that role of being a life jacket when waters get rocky. We have migrated our bond portfolio to have mid-duration. We're acknowledging that there's this balancing act that central banks have to play in this environment. We're enhancing returns while still being defensive through relative value and active trading, not just from attractive yields. Volatility creates market dislocations, and active trading helps us take advantage of these short-term opportunities. These days, the only thing certain is uncertainty. Many people disagree with President Trump's actions, even people within his inner circle. But what they do agree on is the unsustainability of the level of US national debt. Over the past century, national debt has grown significantly, but not evenly. Debt moved higher during World War II, understandably. And then over the next 40 years, it stagnated. But then in the 1980s, it's only grown faster and faster. And even over the past few years, it's skyrocketed over 25%. That pace is unsustainable. The quantity of dollars required to merely service that debt is staggering. Part of President Trump's goal is to address this issue, either through revenue from tariffs or through spending cuts, or a combination of both. That is what we're focusing on. Now, at Nicola Wealth, we have always been innovative in our approach to investing. And that holds true for the public markets as well. That innovation has allowed us to achieve lower portfolio risk. We've experienced lower volatility when taking a look at a 1, 3, and 5-year time horizon for public markets. Lower volatility, lower risk. But we have not sacrificed returns by playing defense. In fact, when we take a look at our returns across all of these time horizons, we've had higher returns versus our benchmark. And over the long term, we've achieved nearly an 8% return in public markets, beating our benchmark by over 1.5% annually on average. Higher returns, lower risk. A traditional portfolio in public markets, it's not globally diversified enough. It's overly reliant on interest rates for risk diversification. It's important to be nimble in this environment. Stay defensive for the time being. Stay in the shallow end. But at the same time, look for the opportunities that will likely present themselves and be ready to jump back in the deep end. Thank you.
My name is Mark Hanna. I am the Executive Managing Director for Nicola Real Estate. I am pleased to present the real estate strategies being implemented by our Nicola Real Estate team to navigate this volatile environment. So how did we get here? It started in Q1 2022 when interest rates were at historic lows. We then witnessed 10 successive interest rate hikes totaling 450 basis points. This rapid rise in interest rates has not occurred since the early 1980s and has caught many off guard. By June 2024, we finally started to see relief with the first interest rate cut. Since that time, we have seen 7 consecutive interest rate cuts for 225 basis points, whereby the Bank of Canada overnight lending rate is now at 2.75%. With the recent threat of tariffs by the Trump administration, it would appear that further interest rate cuts are possible in 2025. This is good news for the real estate, as property valuations are directly linked to interest rates. The recent interest rate cuts have provided welcome relief. Typically, there is a 3 to 6 month delay to realize the impact. In the meantime, property values have stopped their decline. With the prospect of further interest rate cuts, property values are positioned to increase in the near future, which is a welcome sign for real estate investors. Let me explain how high interest rates have impacted real estate values. The market has been challenged over the past 24 months. For example, cap rates increased, causing property values to decline. Transaction activity grinded to a halt due to the imbalance of buyers to sellers. There's a severe shortage of capital, forcing many players to the sidelines. Some capital has been totally wiped out, especially with the declining land prices. This creates an imbalance of buyers to sellers ratio. And the end result is that real estate returns are stuck in neutral. And to add more challenges, the threat of on-again, off-again tariffs is creating uncertainty and making everyone very dizzy. All of these challenges that I just outlined is enough to discourage most investors. Many industry players have never experienced this economic cycle before. Fortunately, we have an experienced real estate team that is up for this challenge. We can only focus on things that are within our control. So what is Nicola Real Estate doing to combat this environment? Well, one of our biggest strengths is our people. With offices in Vancouver and Toronto, Nicola Real Estate has a fully integrated team comprising close to 100 experienced specialists that includes acquisitions, development, asset management, leasing, debt procurement, finance, and property management. So we have a strong leadership group that is fully committed to navigate the team through this turbulent environment. Our entire real estate team is resilient and dedicated to achieving great outcomes for our clients. You've heard me say many times that not all funds are created equally. Fund composition matters, and this includes asset class and geography. Selecting the right asset types that perform well in a stressed environment include industrial, multifamily rental apartments, seniors living, and self-storage. Geography also matters, as we only invest in major markets and strong secondary markets. Overall, our goal is to achieve rental growth, value creation, while maintaining high occupancy. To further illustrate this point, this chart highlights the occupancy for each quarter in 2024 for both of our income funds. The results demonstrate very healthy occupancy ranging from 91 to 96%. If you can keep these assets leased, cash flow serves as a nice counterbalance to higher interest rates. Similar to fund composition, debt management is also critical in this higher interest rate environment. Our income funds are not over-leveraged, and we have a very reasonable overall weighted cost of debt. We also have a balanced mortgage maturity profile with minimal exposure to any one particular year. In a capital-constrained environment, maintaining liquidity is critical to ensure that you can be opportunistic. This is done by reducing our development exposure, being strategic with tactical dispositions of non-core assets, more conservative approach to underwriting with healthy contingencies, maintaining a higher than normal level of cash reserves. And speaking of tactical dispositions, we have been successful in selling non-core assets in both our Canadian and US income funds. These assets were selected because they no longer fit our current investment criteria, and we are able to achieve a positive return taking advantage of the value add created by our team. In addition, these dispositions have created additional liquidity that can be redeployed for new acquisitions. Our build-to-own program in our income funds is an important strategy. Building new industrial, multifamily rental apartments and self-storage projects provide a very attractive leverage return for our funds. Our investors also benefit from the developer profit versus paying full retail to someone else. However, we also want to be cognizant of ensuring that the fund produces an attractive distribution for our investors. Finding the right balance of new development has been one of our goals. Higher interest rates can impact overall cost of these projects. This is why our team is more comfortable with a 10 to 12% exposure at any one time to new development projects while still providing reasonable cash flow distribution. Going forward, our Nicola Real Estate team is optimistic that there are good times ahead for real estate. We are going through a period of price discovery where asset values are being reestablished. This environment has further highlighted that capital-intensive assets, such as high-rise office, can be punitive to overall returns. We have learned from experience to focus on the right asset classes that are resilient in a stressed environment to weather the storm. Strong rental growth serves as a great counterbalance to rising cap rates. Debt management is critical to your overall bottom line. Managing debt levels contributes to better overall returns. Build-own development is an important part of our strategy, but we will keep it at a manageable level. And finally, nothing beats maintaining high occupancy. Cash is king. For more than 20 years, we have accomplished this with a talented in-house real estate team and strategic fund composition.
I'm Rob Olson, Head of Private Capital. What if each of you could access the same investing playbook as the world's largest and most sophisticated pension funds? I'm going to cover 4 topics that set the stage for exactly that possibility. The Maple 8 model, why private capital, the future of private capital, and finally Nicola Wealth's unique approach. Let's start with some background on the Canadian pension fund investing model, as that is what we try and emulate with our private capital business at Nicola Wealth. I'm going to focus on the 8 largest Canadian pension funds that have been coined the Maple 8. Many of the Maple 8 changed their investing strategies over the last 30 to 40 years to include exposure to private markets. All that has happened with that private capital exposure over time is that it has increased. In fact, the Maple 8 have grown their percentage of investing dollars to private assets to be on average 36%, with the largest of these, CPPIB, having 57% of their AUM invested in these categories. But others like Ontario Teachers and BCI are also above 50%. When I reference private capital or the private markets, I'm using these generic terms to capture the investing platforms such as private equity, private debt, venture capital, infrastructure, secondaries, and mortgages. These large investors have the choice to either invest in closed-end or open-ended evergreen models through externally managed funds, participate in co-investments, which are typically provided with better economics, or they can invest directly in companies through their own origination activities. Initially, only the largest of investors, such as the Maple 8, were able to access these asset classes because the minimum dollars required to invest were significant, and to create proper diversifications of assets by type and geography took massive balance sheets. Additionally, although they started out investing primarily in Canada, today many of the Maple 8 look for private capital investing opportunities around the world. And to achieve this, they have created dedicated teams to run these various sub-investing strategies with compensation and independent governance structures set up to attract the best talent available in the market. So why did the Maple 8 decide to invest in private capital? Perhaps the primary reason is that over any reasonable time period, private assets have resulted in higher returns versus the public markets. Anywhere between 3.5% to 4% a year on a compounded basis over the last 25 years is what's often quoted. Another key reason this asset class is attractive to the Maple 8 is that private asset returns are generally not correlated with the public markets. And some private assets, such as infrastructure, actually act as an inflation hedge. But perhaps the biggest reason for the attraction to this segment is the proliferation of attractive private capital options to choose from, whether that's by asset class, such as private equity, private debt, infrastructure, so on, or the ability to choose what companies, industries, and geographies one finds most attractive. This abundance of options has allowed pension funds to build diversified portfolios of long-term, stable, and reliable returns that complement the rest of their asset mix. Think of building an effective private capital portfolio being much like constructing a hockey team or a football team. Each piece is a critical component, and when the right mix of players are found and operating in the right positions, a championship caliber team can be achieved along with superior financial rewards to their investors. So, what does the future look like for private capital? Well, most importantly, this segment has enjoyed terrific growth. It currently represents approximately $20 trillion of global AUM and was just $5 trillion only 10 years ago. Further, the future for private capital opportunities continues to look favorable. Even after factoring in the economic headwinds created by Trump's on-again, off-again tariff policies, several things should help support continued success in private capital, including the growing population of companies to invest in. In fact, companies are remaining private for longer, which is diminishing the number of public company options. Over the last 25 years, PE-owned private companies in the US went from 2,000 to 11,500, while the number of public companies on the New York Stock Exchange and NASDAQ fell from 7,500 to 4,600. Other things driving the future is that there's a significant pool of private capital dollars available to invest, what we call private capital dry powder, and that currently sits at $2.6 trillion versus $157 billion in 2000. Additionally, the number of years portfolio companies have been owned by their private capital sponsors has almost doubled to currently be over 5 years. And these owners will be looking to show realized returns, which should act as a catalyst for private market M&A. Several other factors impacting private market growth are falling interest rates have begun in Canada and the US and will eventually help accelerate mergers and acquisitions, especially once there's greater clarity on Trump's permanent tariff plans. One relatively recent creation from the private markets that should continue to accelerate exit alternatives, even in an uncertain environment, are secondaries transactions. This exit alternative enjoyed $165 billion of private capital transactions in 2024, doubling in just 5 years. And secondaries investments have become a growing part of our own private capital portfolio the last few years. so much so that we recruited a secondaries leader to our Nicola Wealth platform in 2024. Another factor suggesting greater growth in the future is a little known fact about private capital owners. That is, they typically conservatively value their holdings, and therefore the better sponsors achieve a 20 to 30% bump in valuations upon exit. With a growing portfolio of unsold holdings, this could help drive improved returns in the future. Okay, with the background and the virtues of private capital established, why institutional investors such as pension funds love it, I'm going to finish with Nicola Wealth's unique approach to this asset class and how we make it attractive for our private wealth investor base. Firstly, we provide access to all the key private capital asset classes. But just like my earlier hockey or football team analogy, we put significant focus on creating the optimal mix of these private capital options based on the environment that exists. Each of these asset classes don't always move exactly in the same direction at the same time, but all remain relevant today. As examples, infrastructure, private debt, and secondaries are structurally configured to be more resilient in a more challenging environment like we're experiencing today. Further, we know that private equity benefits from reducing interest rates, and also the most compelling private equity vintages, from a return perspective, tend to occur immediately following a major economic downturn or crisis. Another unique feature of our private capital offerings are they're provided through open-ended vehicles with no minimums and relatively short redemption periods. We have a large 33-person team, and the vast majority of our private capital leaders were recruited from pension funds or other large institutional investing platforms. This team is part of a larger 120-person asset management group at Nicola Wealth, which ensures we have deeper industry insights and a more efficient back office capability. This scale also creates opportunities for us to continue to enjoy access to significant deal flow. And we know a large funnel of investing opportunities is a key element to determine success. In this regard, we reviewed nearly 1,000 qualified opportunities in 2024 and only invested in 85 of those situations. Most importantly, our underwriting process sets us apart. We rely on significant access to non-public information and therefore carry out deep due diligence on all investment opportunities. This diligence is carried out at two levels. Firstly, at the private capital sponsor level, and then at the underlying company being considered for investment. A pragmatic, diligence-based process is critical in private capital. If one just isolated global PE funds and their portfolio companies as an example, there are well over 18,000 PE groups and over 30,000 portfolio companies to consider investing in. Not all of these are top quartile opportunities, so significant diligence and a large team to process and determine what are the right opportunities is key to be successful in this space. Our underwriting process includes an independent investment committee, includes 2 past senior investing leaders from the Maple 8, and a former key partner from a successful private equity firm. We focus on delivering long-term sustainable returns similar to the Maple 8, and with a tangible focus on downside protections, using things such as managing single name exposure to be less than 3% of any of our private capital verticals, and ensuring appropriate diversification by geography, industry, and vintage. From a geographic perspective, although our entire team is based in Canada, our investment mix is global. Approximately 75% of our PE, infrastructure, and private debt portfolios are in the US. With respect to industries, we follow specific protocols and diversification. And in the current environment, there will be a continued pivot to more resilient sectors such as tech, healthcare, services, and infrastructure more broadly. And lastly, just like the Maple 8 pension fund community that we try and emulate, we know that timing the market is impossible. So we will continue to be disciplined, yet opportunistically invest to ensure an appropriate private capital portfolio, regardless of whatever environment we face. Thank you.
I'm Vanessa Flockton, President, Private Wealth. As many of the presenters today have suggested, it's a challenging environment right now. We have significant geopolitical challenges, a tariff war like nothing we've seen in generations, stock market volatility, and concerns regarding the impact on currency, interest rates, and inflation. So the question is, how do you approach planning and investing in such an unstable environment? We've already discussed the macroeconomic environment and how you can create the right asset allocation and portfolio to mitigate risk. But I expect many of you are still wondering, what does this mean for me and my family? How does this fit in with my personal financial plan? What changes should I make, if any? And what should I be discussing with my advisor? What I'd like to do today is to take you through a process that I hope will help build peace of mind and give you confidence that at Nicola Wealth you are well positioned to weather the storm. Each individual family we work with has a unique fact pattern, objectives, and risk tolerance. So as advisors, before talking to clients about what they should or shouldn't do, the first thing that we need to ensure is that we understand our clients and address feelings of uncertainty or fear. We can do that by walking our clients through a process. But first, there are some things that we need to understand. What keeps you up at night? What do you hope for your family, career, and business? What are your lifestyle objectives and risk tolerance? What's your net worth, liquidity, exposure to debt? How much cash flow does your portfolio create? And what's your spendable income need? Do you know what your effective tax rate is? Very different from your top marginal tax rate. And do you want to give money away? And if you do, how much and when? And do you want to help your children and grandchildren? Once we have this information about your current reality, we can create a customized financial plan for you and your family, review it regularly, and adjust it as needed. So now we understand you, your hopes, dreams, and fears. The next thing we need to do is consider external factors that can impact your plan. This could include tax reform, an impact on your compensation and investments, your own personal behavior, and how do you react to uncertainty, your risk tolerance in your investment portfolio, our estimates for future returns, and the macroeconomic and geopolitical environment. Once this has all been considered, we're ready to set an asset allocation for your portfolio that is diversified and focused on cash flow producing assets. I always tell clients that the best way to build wealth is to first have a plan, and then you need to set the right asset allocation. Track the plan and have the discipline to rebalance to that asset allocation regardless of the macroeconomic environment. Individual investment decisions about securities should always be secondary to the asset allocation decision. And when you consider which individual securities you should focus on, you need to invest in ones that produce cash flow. What we want to achieve is that your cash flow is sufficient to replace your working income in retirement. That helps us reduce overall volatility and create stability for you. So at Nicola Wealth, what this means is that it's actually time to get back to basics. We've been doing this for 30 years. We have a secret sauce, and that secret sauce has delivered consistent and stable results for our clients. Secret sauce is a plan, a diversified asset allocation, and cash flow producing assets. When you implement this model and use this secret sauce, you have lower risk and volatility, which results in better client behavior and ensures that we don't make emotional or short-term decisions based on discomfort or fear. So to put this in context, I'd like to show you a chart. Over a 24-year period, a client who invested $1 million with us would have a portfolio that is 72% or $2.3 million larger. What this tells me is that over the long term, our approach works. It promotes peace of mind and better investor behavior. What I'd like to do now is illustrate this Nicola process for you in more detail with a case study. Although every client is different, there are some similarities, so let's take a look at this situation for a sample Nicola client. So here we have Ruth and Charles. Ruth, age 61, Charles is age 64, incorporated professionals. They're considering retiring in the next few years, and they have one adult child, Judy. They have been Nicola Wealth clients for over 20 years. In the current uncertainty, Ruth and Charles may be asking themselves, am I still going to be able to retire in a few years? What happens if our portfolio drops significantly in value? Should we go to cash, given the level of uncertainty and outlook for the economy? And will we still be able to help Judy buy a house? Are there any other planning options we should be considering right now? So what we need to do to start is we need to understand Ruth and Charles's current reality. And for those of you that are Nicola Wealth clients, you'll be very familiar with the Nicola Net Worth Statement. It's the foundation of our digital financial planning workbook, and it allows us to get a snapshot of Ruth and Charles's current net worth. We can see how much money they have in retirement portfolios, how much they have in their business, any debts that they have, and what's available for them to generate income in retirement. So what we can see is that Ruth and Charles have a total net worth of almost $14 million, and they have total investable assets available to generate income in retirement of almost $8 million. So what we need to do is say, okay, well that's great. We know they have $8 million. What we want to understand is, how does that fit with the objectives that they have? Can they retire the way they would like to? So the next step that we take is we look at the Nicola Wealth long-term projection. And so on this projection, we reconfirm Ruth and Charles's ages of 64 and 61. We assume that they're going to live a long life to age 90. We know they've got $8 million in passive investment assets, and we're going to make some assumptions about returns and inflation. So we're going to assume a 7% return on an average annualized basis after all fees and 3% inflation. We're also going to assume that Ruth and Charles have a 25% tax rate. And many of you may say 25% in Canada, really? When you are incorporated and you can income split in retirement and you invest in a tax efficient way, we can bring that tax rate down to between 20 and 25%. We also need to know what Ruth and Charles's other objectives are. They have a secondary home that they plan to sell, so we know there's going to be a cash infusion from that. And they do want to gift money to their daughter, Judy. The other thing that they've told us is they have a retirement need of $240,000 a year after tax, $20,000 a month. So when we consider all these different objectives, we can then determine, what does their residual portfolio look like? Ruth and Charles's portfolio, assuming these assumptions come true, will continue to grow. And at their age 90, it will be the equivalent of over $12 million in today's dollars. So what that tells us is that Ruth and Charles are not going to deplete their capital. They're going to continue to grow their portfolio over the time. And the critical things on these assumptions that make the largest difference over the long term are the number of years you spend in retirement, the return you get on your investment portfolio after all fees, and the amount of money you're going to spend. So what we want to do now is make sure that Ruth and Charles can achieve these objectives. And one of the ways we can fact check that is by looking at our client dashboard. So on our client dashboard, we start with Ruth and Charles's overall portfolio of almost $8 million. And what we can see here is that over the last 20 years, they have had an average annual return after fees of 7.04%. And what's important here is you can remember on the projections we suggested 7% return, but we also suggested a 3% inflation rate. And the average inflation rate in Canada over the last 20 years has actually been 2.09%. So Ruth and Charles have had almost a 1% outperformance over and above our projections. So we know they are conservative. You know, Ruth and Charles may look at their dashboard and be concerned that on a year-to-date basis, their portfolio is negative 1.7%. Compared to a balanced portfolio, that's a positive result. A balanced portfolio is down 4% year-to-date. But we don't really care about short-term results. What we really care about is the long-term average annual return we can get for our clients. The other thing that we're really interested in is how much cash flow does this portfolio generate? In 2024, Ruth and Charles's portfolio generated $250,000 in cash income. That's a combination of interest payments, dividends on stocks, and rent on real estate. It was an average cash yield of 4.1% after fees. And if you'll recall from those projections, it's sufficient to meet their spending needs and retirement. So when you know that your cash income on your portfolio can replace your working income, you don't have to worry about short-term volatility in your investment portfolio because you're essentially clipping coupons, and we know we're buying quality assets that will perform well over the long term. So what I want to do is circle this all back to consistency and stability. What we care about is long-term returns for our clients, and how do we perform in crisis situations? So even in 2008, which was one of the worst financial crises we've seen in generations, Ruth and Charles's portfolio would have gone down about 6.5%. But the S&P 500 was down 42%. What that did is made them feel that on a relative basis, they were doing very well. It promoted good investment behavior. They stayed the course. And that is why we can achieve really good results for our clients. So if we want to go back to those original questions that Ruth and Charles had for us, will we be able to retire in a few years? We have confirmed that they can. It doesn't matter if there's some short-term volatility in your investment portfolio, the cash flow is sufficient to meet your spending needs. We don't need to worry about uncertainty and going to cash in an environment like this. We know we're buying quality assets. We know that they're producing good cash flow. And so again, it's about staying the course and knowing that we have a secret sauce. We've confirmed they can help Judy with a down payment on a house. Now, the other thing they may have asked, which we haven't addressed yet, is what other planning opportunities should they consider in the current environment? So planning and tax minimization opportunities. You know, the opportunity to maximize RSPs, tax-free savings accounts, and individual pension plans. If you're incorporated and you can have an individual pension plan, please ask your advisor about it. If you are incorporated, you may have capital dividend account balances in your corporation, which can be withdrawn tax-free, used to fund RSPs and tax-free savings accounts, or used to gift money to family or your children. Corporately owned life insurance can be used with or without leverage and is an alternative investment vehicle that is very tax efficient, both during your lifetime and in your estate. For those of you who have charitable intent and plan to give money away in your estate, you can use a planned giving approach during your lifetime. We have a donor advised fund that clients can use to assist them with that. And then income splitting in retirement. You know, it's not as easy as it used to be, but Ruth and Charles can income split from their corporation after age 65. They can also make sure then that they're taking dividends from the corporation between 65 and 71, and then post 71, take funds from their RSP and IPP when they have to start to collapse them. What I've demonstrated today is that yes, the macroeconomic environment is unstable, and it may be time to play defense. But the Nicola approach was built for this type of environment. And in our view, it's time to get back to basics. Focus on the Nicola secret sauce, a financial plan, diversified investment portfolios, cash flow producing assets, and minimizing tax where you can. Many of you have questions, and we have answers and solutions. We're here to help. So please reach out to your advisor, and we'll look forward to hearing from you soon.
I hope this has offered you greater clarity and perspective on the challenges we face today and those on the horizon. We continue to take a disciplined, long-term approach to investment growth and wealth preservation. It's the kind of thinking that defines who we are at Nicola Wealth, committed to helping individuals and families not only navigate uncertainty, but move forward with confidence when opportunity emerges. As I said before, this year's theme is defense by design. And with each presenter, you've seen exactly what that means. It is not simply about reacting to uncertainty and volatility when it happens, but rather about being prepared through diligent financial planning and resilient, well-diversified portfolios designed for the long term. On behalf of our entire team, thank you again for being with us. We look forward to continuing the conversation and helping you achieve your goals in 2025 and beyond. Take care, and thank you for watching.